And the last topic or section is going to be on depreciation, and we'll be doing plenty of problems with depreciation as well, these different depreciation methods. The key thing, just as an overview first, is depreciation is a non-cash expense. We've talked about this in class already. It's not an actual cash flow, but it's relevant because of its effect on taxes, and we have shown that the tax savings is the expense of depreciation times the marginal tax rate, T. So our depreciation tax shield is what we call is D times T, which is essentially a benefit to us, right? You're paying, this is, instead of paying that amount in taxes, you're keeping it in the firm. You're not, you're not necessarily getting it back, but you're not paying it out. And so we need to definitely account for this in our analysis. We know that the depreciation method itself is going to be important, and I want to walk through that now. So what we've used to this point in building our pro formas is straight line depreciation, where we take the initial cost minus the salvage value divided by the number of years. And for us, we actually assume the salvage value to be 0. Many times the problem will explicitly state this, depreciate straight line to 0. But we're actually, even if we don't, we want to sort of, from a tax perspective, maximize our depreciation up front. And then if we have to pay tax on the difference between market value and book value at the end of the project of what we can of the salvageable asset, that's fine. So that's one way. It's a very straightforward way. Take the number of take the initial cost divided by the number of years. That's our depreciation per year. It's even. Of course, it's not exactly. Intuitively, it's not. Doesn't quite make sense. So think about when you buy a new computer. You buy your new computer, it works best and fastest, and it's most valuable right at the start. And as time goes on and as you use it, you're going to lose some of that value. And so I think that that's something that you definitely need to be thinking about, and we can account for that by using something called Modified Accelerated Cost Recovery System, or MACRS. For this, this is actually given to you by the IRS, and I'll explain that more in a minute. But basically what you do is each year, the amount you depreciate changes. Where we depreciate more upfront when it's more useful, we're trying to measure the usefulness of the asset here. And so what we're going to do is basically figure out, where does my asset fall, what type of property class is it, and then we'll use a table provided by the IRS. So I provided those two tables here. This is IRS publication 946. You look up what your asset is. Let's say our asset is office furniture. That falls in the 7-year property class, and so you would basically, you said, I'm going to depreciate my office furniture, I'm going to use the 7-year property class. Then you go to this next table. And in this table, it tells you how much percent do you depreciate per year. So if we're in the 7-year asset class, you would depreciate 14.29% in the first year, 24.49% in the second, 17.49% in the third, etc., etc. Notice two things. One, these percentages all add up to 100. So by the end, you've fully depreciated your asset. Two, the first and last year are half years. So you don't know when exactly you purchase your assets. You don't know when you should start depreciation. So we just treat it as half years. So the 7-year asset class will actually have 8 years of depreciable life. It's just that the first year is half a year and the last year is half a year. So it's 6 full years in the middle, and then bookended by half years, which gives you the 7th full year. This is very straightforward. This is the tax, the IRS is telling you this is what you can do from a tax perspective. You just basically plop it in. The benefit for us in finance is you get more of the tax shield, the tax benefit of depreciation earlier on, and from a time value of money perspective, that's a good thing, right? We want cash earlier. It's more valuable. And we'll go through a lot of examples of this in the problem sets. So I'll hold off there, but this is my overview deck. You'll see the problem sets coming. I think the last piece of this is, before I talk about the sale of old equipment, is just to compare straight line versus MACRS. And I think there's multiple there's sort of multiple books that exist. You have the company books, you have the tax purpose books, how much taxes you pay, and they may differ. And so the company books typically use straight line because it increases your income early on. In other words, you have less depreciation earlier on, which gives you more net income because you have less of a depreciation expense, more net income. And from a company book perspective, that's a good thing, higher earnings per share. For tax purposes, macros is better because you reduce the taxable income early on. And so, you'll see this where companies can choose different depreciation methods depending on what exactly they're reporting. And that is commonplace, and that's something that you can be aware of. I think for capital budgeting, the macros is actually beneficial because of that taxable income component, that you're reducing some of the taxable income early on, but you can choose. And finally, when it comes to depreciation, that's going to then impact the book values of our asset. Many times a project will end, and as you're estimating the end of the project, you'll have the opportunity to sell the assets. As an example, you might build a factory, use it for 5 years, and then you're going to exit the business or whatever, stop making the product, but whatever you do, you might sell that factory. Or even if you don't sell it, it's an opportunity cost that you could sell it. You should take that into account at the end, that value. When you sell it, you have to pay tax on it. If you are receiving more than the book value, and if you're receiving less than the book value, you actually get a tax benefit, and that's what we're showing here. The after-tax salvage value is the market value minus the difference between market and book times tax rate. Ideally, market value would equal book value, but many times that's just not going to be the case. It's really hard to estimate it's really hard to estimate what things are going to look like in the future, obviously, and many times things might not have a book value from a depreciation perspective, but they still certainly have market value. Maybe it's just scrap metal value for all I know, right? Depending on the project. So if the market value is above the book value, you will pay taxes on the gain from your sale. But if the market value is less than the book value, that means you haven't depreciated enough, and you actually will get a tax refund. And the formula will plop that out for you. So you don't have to do anything as long as you follow the formula. But do keep in mind that if that after-tax salvage value, the market value might be $100, and the after-tax salvage might up being $200, which means you're getting a tax benefit of $100, and that would be okay. So keep that in mind as you're doing these problems.